How can you make money when prices are rising? Options are limited because the stock and cryptocurrency markets are in bear territory and US inflation is at a 40-year high. Start by determining your financial needs and risk tolerance if you want to make money during inflation. Are you seeking immediate passive income or something that will pay off later? In this video, we're going to be looking at 10 ways to make money during inflation. But before that, make sure to subscribe to the channel and hit the bell icon for more amazing content. Let's start with the video now without further delay. Inflation 101. The percentage change in price over time is known as inflation, typically 1 year. Without including energy and food, which has a greater tendency to fluctuate, inflation is often defined as the average increase in the price of household items. A certain degree of inflation is beneficial because it shows that there is more demand for money than supply, which promotes economic expansion. The Personal Consumption Expenditures Price Index, or PCE, is a gauge used by the US Federal Reserve. One more often used metric is the Consumer Price Index, CPI. Anything beyond the Federal Reserve's 2% target rate is regarded as high inflation. How the economy is affected by inflation. A rise in consumer prices could have unprecedented repercussions on the local, national, or even international economy. In general, inflation reduces people's ability to buy things, which lowers the value of their money. People can buy fewer items when they have less purchasing power, which inhibits economic expansion. Workers often demand greater pay when there is a general perception that high inflation will continue, which can result in a wage price spiral. How governments control inflation. Understanding how inflation and the normal government response to it affect the economy is crucial for making money during this period. Increasing the minimum interest rate, which is the rate at which banks and credit unions can lend money to one another without collateral, is the primary method used by governments in the modern age to control inflation. Rising interest rates has a cascading effect that makes borrowing much less appealing and hinders economic development. The interest rate on savings is rising at the same time, giving the impression that saving money is preferable to investing it. Raising interest rates too quickly can have negative consequences. However, accelerating the rate of increase can result in a bear market, an economic downturn, and/or significant unemployment. Employment and interest rates move in tandem, slowing economic expansion. As interest rates rise, it becomes more expensive to finance a home or business. Companies and people spend less as a result, increasing unemployment. Increases in unemployment can also raise the cost of production, which lowers demand and the number of workers that businesses require. During inflationary situations, certain asset types profit. Looking to profit from inflation, the macroeconomic effects of inflation, such as higher interest rates and unemployment, as well as its influence on public opinion, can decide which assets outperform and underperform. Inflation is notable in and of itself. After interest rates are raised, which is often characterized by slower economic growth, tangible assets are also thought to perform well, as are intangible assets whose value is linked to tangible assets. Here are a few strategies some people may use to invest during an inflationary period in order to profit from a subsequent bull market, keep up with inflation, or generate passive income. Number 10. DeFi Savings App. A new way to make money during inflation. Decentralized finance, or DeFi, as opposed to riskier options like Bitcoin and stock investments, can produce a steady return of 3 to 8% annual percentage yield (APY). The DeFi Savings app, in contrast to high yields savings, offers free USD deposits and withdrawals, $100,000 in fund protection per user, $250,000 for Geld Concierge, and non-custodial technology that keeps your money provably in your control. Number 9. High Yield Savings Account. The benefits of cash during inflationary periods. At the time of writing, a high-yield savings account in traditional finance pays 1% APY. Even though this type of account won't generate income during inflation, it does let you keep some cash on hand, which can act as a buffer for any economic downturns that may come after an increase in interest rates. Number 8. Real estate. A timeless inflation hedge. Renting out real estate is a tried and true way to make money during inflation since it can generate a consistent flow of funds. Since house prices typically rise along with inflation, owning property alone is frequently regarded as a hedge against it. You're essentially making fixed-rate mortgage payments on a home that is now worth more than the amount that you paid for it, since a higher home value decreases the loan-to-value ratio. Increased property prices also result in higher rentals for those who own rental properties. Number 7. Making money during inflation with REITs. You want to own real estate, but you don't want to be responsible for all the duties that come with it. A real estate investment trust is one option, REIT. A REIT is a collection of properties that includes everything from office buildings to malls to hospitals. If you want a more liquid real estate asset, it's a terrific investment, and risk-averse investors might find it to be a good fit. There are real estate investment trusts for people who are unable to own a home. A REIT is a business that owns properties that generate income, including apartments, hotels, resorts, shopping centers, and more. 90% or more of REITs' taxable income must be distributed to shareholders in the form of dividends. Increased dividend payments to REIT investors may result from rising real estate values. Because REITs' quality varies, do your own study. Number 6. Can you profit from stocks during an inflationary period? Equities or stocks typically do better than inflation historically. The S&P 500 index returns on average are over 10% annually, which is higher than the 40-year high US inflation rates expected in 2022. Short-term volatility risk is associated with stock investing during times of high inflation. For instance, the S&P 500 had double-digit negative returns in Q1 and Q2 of 2022. In the near future, are you looking to profit from inflation by investing in stocks? Think about the stock's type. While businesses that can pass cost increases on to customers and those whose value is based on commodities will fare better, dividend stocks frequently suffer amid inflation. Number 5. During inflation, commodities fare strongly. Gas, cotton, soybeans, wheat, oil, and copper are some examples of tangible assets that frequently outperform other asset types and gain value during inflation. Since the price of specific resources tends to react to economic changes more quickly than other prices, an increase in commodity prices alone can predict future inflation. Commodity futures are frequently traded by seasoned investors before or during inflationary episodes. Be aware that commodity indexes typically perform poorly. Number 4. A safeguard against inflation is gold. Although it's not always the case, the commodity gold is frequently thought of as a way to keep or make money amid inflation. In addition to purchasing gold, a prospective buyer must take opportunity cost, price volatility, and storage into account. Investing in treasuries or stocks may be a more reliable strategy to generate income during an inflationary period. Another option is to purchase a gold exchange traded fund (ETF), which tracks the price of gold bullion by investing in gold trusts and gold mining companies. Note that these two types of ETF are taxed differently. If you currently own equities and bonds, diversifying your portfolio with a commodity such as gold might be a wise move. Although you can purchase tangible assets like gold bars or gold chains and own them, you'll still need to worry about securing and insuring them. You may also put money into a gold IRA or a mutual fund that invests in precious metals if you'd prefer not to deal with the trouble and expense of keeping gold bars and coins in storage. Both might be simpler to purchase than actual metal. Number 3. Can you make money on cryptocurrency during inflation? In the world of finance, cryptocurrency is all the rage, but what exactly is it? It's virtual money that is traded between investors and protected by computer networks. Most likely, you've heard about some examples like Bitcoin and Dogecoin. The interplay between cryptocurrencies and conventional financial instruments like the stock market, inflation, and interest rates has changed over time and is still a hotly contested topic. It's no accident that the first Bitcoin block was created in 2009 at a time when the current banking system was widely despised. Many proponents of Bitcoin criticize Federal Reserve practices like quantitative easing (QE), which involves buying securities to lower interest rates and expand the money supply. But as Bitcoin has gained in popularity, its price has become more closely tied to the stock market. In general, the price of Bitcoin tends to increase the more wealth a person has across all asset classes. Similar to equities, cryptocurrencies may outperform inflation over the long term, but they may face big price swings over the short term. Number 2. Bonds during periods of inflation. An investor's purchasing power may be maintained with the use of bonds. Despite the fact that US savings bonds may lose money during periods of inflation, they are made to keep up with it. Bonds have historically served as a buffer against volatility because many more speculative assets would experience value declines at the same time. If you want to diversify, bonds can be another option for investing. You can pick between treasury bonds issued by the federal government, municipal bonds from local governments, and corporate bonds issued by both private and public firms. Even better, think about investing in I-bonds, which are government-issued savings bonds designed to shield investors from inflation. Be mindful that bonds are only issued for a certain period of time, which could affect when you receive the entire amount of your investment. Number 1. Diversify your investments. During periods of inflation, the proverbial saying, "Don't put all your eggs in one basket," is even more applicable. You might be able to maintain momentum toward your long-term investment objectives by diversifying your portfolio. The market's impact on your investments may fluctuate if you have different sorts of investments. During the same market conditions, one investment may have a value loss, while another may maintain or even increase its value. Your financial objectives, risk tolerance, and short and long-term demands will all influence how you diversify your investments, but there are a number of wise methods that you may look into. That's it, guys. These were the 10 ways to make money during inflation. If you like this video, please subscribe to the channel and hit the bell icon. Leave a like, share it with your friends and families, and jot down your thoughts in the comment section below.